Good morning, everyone. Welcome to the Friday opening playbook for September 26th. Good morning, Nathan. Good morning, Graham. How you guys doing?
Doing pretty awesome.
Market is ripping. Graham, you made me nervous that, I don't know about our trades, but I am currently 7 for 7 on our.
I'm 3 for
trades.
4.
So I'm feeling pretty
Amazon
good.
was about flat.
Oh,
so I'm getting Amazon to flip. I'm 4 for 4 on the
Walmart just turned red, so now I'm 6 for 7. But yeah, we got the 3-day fade and a bounce, exactly like we talked about. Now, we'll ignore the fact that we thought we might get it after 2 days and just focus on the fact that we did get it after 3 days. But yeah, I mean, pretty healthy across the board. Frankly, I was worried about SPY after that nice pop on kind of neutral news and the sell-off going right into the open, but it has recovered and then some, ripping higher. The only real disappointment, I'm kind of looking across here, the only real disappointment for me is CLSK kind of cratering today because I wish I would have taken some profits.
I was going to say that too. CLSK is down, 7% today? Is that right?
8.9%.
Down 8% in Nate. Now my options trade, it's only up 216%.
I know.
Yeah,
it is pretty wild.
We had some people take some profits. They may be smarter. We'll see. We still have about 3-4 weeks on that. I actually sold it in my retirement account because I was thinking this is a little crazy right now on the underlying. I was hoping to buy a little dip, so we might get that here. It's just going to move like crazy, but I don't think our run is done on CLSK.
No, I don't think so either. Now, my only question is because I only have a couple contracts, but Graham, I did the very conservative one because my CLSK is December 19. So I'm actually thinking about adding to that same position here on a 9% dip. Let's see what else we got. By the way, I got a pretty interesting little thing I found out. I don't know if I would say it's game changing, but I think it's kind of interesting. A little discovery as I was working on some stuff today. So I'll plan on showing that here today. And I know that you had a O'Reilly trade that you were going to talk about. So couple interesting things.
I do have an O'Reilly trade, but first we did have Mike H. I saw David and Mike H are going at it here in the chat. Mike said finally a winner on overnight options. Dave said one loss. You say finally winner. Well, I am here to take Mike's side because I love beating up on Nate. He had 2 losers, guys. 2 losers over the last 30 days. Come on, guys.
I finally. Wow,
let's not talk about the 12 winners that happened over that time. Let's talk about those 2 losers. Yeah. Let's take it out on Nate now.
Well, you know what? To be fair, I did have 2 losers, and I am. You know what? I'm going to do a little mini training here, and in full transparency, which I try to do, the training says, "Hey guys, we took 2 losers this week," which is obviously incredibly rare. But I want to kind of talk about it and some of the reaction we got to that. So. Fair enough. You can throw that heat my way.
No, we're obviously giving you guys a hard time, Mike. We're giving you a hard time too. The big deal is the long run trajectory. Everybody gets started at different times. You might be the one person that starts right before we go on a 12 trade hot streak. You might be the person that starts the day we end that hot streak. But the cool thing is just seeing the long-term trajectory. That you're almost 1 full year into the live trading, live membership for overnight options, and over 500% total return on investment. Depending on whatever starting stake you start, picture your starting stake, keep it flat, do it for the whole year. You're over 500% return on investment. So yes, that's awesome.
Yep. I don't, Brandon, I don't know exactly what you're pulling there. Maybe depending on if you start with a losing streak there, I'm not sure. You'd have to show me. August 1st through now, 8,800 is what I show. So in less than 2 months, that would be around a 200% net ROI. Which in 2 months, usually I'm happy with 200%. So I don't know. I'm the last. Don't want to be here and defend myself when we take losers because we did take losers and that's part of the game. But also just want to make sure we're all speaking the same language and saying the same thing. So anyway, Graham, do you want to start with your O'Reilly trade, or do you want to?
Let me do that. Let me go ahead and do this. I told you guys yesterday we would be doing this. We should have taken a moment. Well, I can't really say should have. I mean, the closing playbook is specifically for those fast flying trades. So this one probably wouldn't have been as perfect for that. Let me share my screen here, send you guys into the vortex, and we'll get rock and rolling with an O'Reilly trade. I think Wreck-It Ralph keeps bringing up the O'Reilly trade because I think he's in it and maybe having some fun, but we'll go ahead and cover that today. So if you have the Apex, can you see my screen, everyone?
Yes.
All right. If you have the Apex software, obviously we click here to access that software. It's a beauty. It's the thing of magic. It's amazing. Here's the Apple 3 times in a row. Easy to brag on that. Let's go ahead and flip down here to O'Reilly and see the active signal that we have on O'Reilly. I really like this one. This is a weekly chart here, but let me go ahead and pull up a daily chart of O'Reilly, and I'll show you just a few outside of just being an Apex setup, which we know on O'Reilly. Look at this. Over the last 5 years, does anyone see that? Is anyone impressed by that? This one has hit the target 91% of the time.
It's ridiculous.
91% of the time. Of course, you might say that's just a great, stretch of time. I don't know. Let's pick a random year, see what happens. If I go back 20 years, it's won 80% of the time. All right. So enough of that. Let me go ahead and pull up my O'Reilly daily chart here just to show you another reason why I really like it. If we're looking here, obviously a beast of a stock, but notice how every time it comes around that 50-day moving average, it ends up being a good buy. 50-day average, 50-day average. Now this one dipped below. It doesn't always happen, but you'll notice here, and it's come down and just touched it on September 23rd. So just earlier this week, and you can see it touched it, and it's running. It's working out perfectly right now in line with that signal, and we might even get a better buying opportunity because the signal came somewhere back in here. So we're actually a little bit lower from the entry, but still looking really, really good right now. So we'll go ahead and use the Apex software here to find an O'Reilly entry. Now I'm going to give you 2 different versions. Actually, I'll give you 3. I'll give you all 3 for fun. I'll give you the call option trade, the wrap order, and the max ROI spread. Hopefully the numbers all look good and we can rock and roll with them. Remember the option selection here, it's all automated and it's matched up with O'Reilly's specific unique time. So like, let me flip to AMD just to show you. AMD, if you notice here, is going to have a much shorter time to expiration on the options, 22 days on average for AMD versus O'Reilly. O'Reilly here is 71 days over the last 5 years. So it's gonna know that the system's gonna digest that data and then use that to pick our options expiration. So if you want to trade a basic call option on O'Reilly, here is your criteria. And if you look down below here, the ticker's O'Reilly. ORLY. All right. There's a basic call. You know me, I don't love basic call options because I don't like time decay. But you can see here, this is cool. Little calculator does for you. It just says, hey, if O'Reilly hits that profit target, which you can see right here, if it hits that profit target in 1 week, that's what the option is going to be worth. If it hits it in 1 month, that's what it'll be worth. If it hits it at expiration, so even if it makes it to target expiration, you're still got a really great return on investment, 111%. So actually this call option looks really, really juicy. And remember, this is all timed up with the typical move on O'Reilly. And then the call options you can see here that adds 30 days of buffer just to give you a little extra time on the call options. So that's the O'Reilly basic call option trade. That's about $500. Of course, if you want to trade the way I like to trade, and this is what I'm going to put on today, here's a wrap order. And again, timing up the expiration here with O'Reilly's typical move. It must have moved it to December because O'Reilly doesn't have weeklies. I was wondering why it has December, but it's because O'Reilly doesn't have weekly options, so it has to move it to December. But here's the wrap order debit spread on O'Reilly. You'll notice the strike prices here on O'Reilly are a little bit wonky. This came up the last time we traded it, which we've been doing really well on O'Reilly. But let me just show you. Because there was a stock split, 15-for-1 stock split here back in June, the options were split 15-to-1. So that's why you see these weird strike prices. But we can still trade them. I'm curious, actually, when these are going to reset. All right, it looks like May's reset. March is not. So it'll be May next year when these are reset to normal-looking strike prices, as you can see. But here we have the oh, look at that. Jason says Kane's Maverick tool also just called an entry on O'Reilly as well. Love to see that. So the Apex software gave us that wrap order. It knows the price of O'Reilly, and it's going to put us right in the middle. here at 104, buying the 104, selling the 105.33. And I did not click both. There we go. 75 cents. And the max profit is 133. So it's about 77% return on investment, which of course it just told us that right there. And the cool thing here, I actually really like this one, O'Reilly, because of where this is at with the strikes. It doesn't have to gain very much. It has to gain, what, 40 cents from here? Or not even. It has to gain 7 cents from here. 5 cents now. 5 cents to pay 77% return on investment. So I'll go ahead and grab a few of those here and send that one off. Now, if you wanted to, you could extend that wrap, and I'm sure if you check the Apex software here in a bit and O'Reilly's a bit higher, it will adjust these strikes to wrap the current price. So if you wanted to go one strike out of the money, you could get a little bit lower entry price. But what I'm going to do here is, now that I just got filled there on the wrap order, let me go for a little dice roll play here, really going for that juiced out profit on O'Reilly. And let's see what it's got us here. All right, check this out. So now what this is our max ROI spread. So what this is doing is it's looking at O'Reilly. It's saying, all right, what's that typical hold time? What is that target price that we have on O'Reilly, that one that's been hit 90% of the time? And let's try to time this up with some options, a spread that's out of the money. Now, what you'll notice here is, look at this. Max ROI by expiration, 343%. That's a juicer. And we're talking about O'Reilly here. We're talking about a car that sells, or a store that sells car parts. We're not talking about a tech stock. We're not talking about a Bitcoin crypto sort of company. Nothing like that. This is a auto store, O'Reilly Auto Parts. We can sing the song later if you want to. Look at this. I love it that it can find these opportunities for us. Now, keep in mind, this might only win 50% of the time. Heck, it might only win 40% of the time. But if you run the numbers, if you win 40% of the time and you're only making even 200% at expiration, you're making money over time. So here we're going for 343% at expiration on O'Reilly. Not for a this isn't a high win rate strategy. This is a max ROI spread here on O'Reilly, shooting for that profit target. Let me go ahead and pull it up here. Just those exact options I sent you, trading at 33 cents. So the price is obviously updated a little bit, but right around that price that it gave us. I'm just going to grab one here. It's $33 risk to turn it into, or to make $100 profit. So 33 bucks flips into 133. Let's see if she'll fill. It fills right away. I'm going to see if I can get one for cheaper, which is what the Apex hinted. I'm just going to set one at 30. I'll end up with two there. I'm going to let this sit. I'm assuming it won't fill right away, but I really like this one on O'Reilly. So again, this one is going to go for that max profit target here on O'Reilly, which if you look at the Apex indicator, that's all the way up here. So it's it needs to move. Here's our expiration. It needs to hit that target, but this is what it's shooting for. Going for the full target here on O'Reilly. All right, that's my spiel on O'Reilly. Again, if you want the high win rate one, that's the wrap order. If you want to go for gold, that's the max ROI spread. I did a little bit of both. Ticker is O'Reilly, Alex. O-R-L-Y. Oh, interesting. Dinosaur Skip said they used to be known as Shucks. All right. Oh, I just got filled at 30 cents, actually. So there you go. All right, Nate, that's what I got here on O'Reilly for you guys. From the Apex software, of course, if you have the tool, there's more active signals you can trade today. Some good ones in there as well, like NVIDIA. I really like NVIDIA right now.
Yeah, NVIDIA's starting to get my juices flowing again as well.
Actually, let me ask you guys. You guys want I'll just throw this in the chat. If I get more than 7 yeses, I'll throw you guys an NVIDIA trade in the chat. 85% win rate here on NVIDIA. Let's see what this one's paying. Oh, this can't be right.
Wow, look at the SPY fade right back, man.
Is it?
It's giving it all away.
Well, maybe we'll hold off on NVIDIA then till to next week. Because I only got four in the chat. 5, 6, 7. Okay. All right. Here's the NVIDIA wrap order. Keep in mind, this is going to be a tighter expiration here because the entry is already fired a couple weeks back and it knows the hold time. So it's going to take all of that data into consideration. Here's the wrap order. Right now it's paying 89% return on investment. Let's clean this up. And then here's going to be our max ROI spread, which is really crazy here. Again, it's because the expiration is a little bit tighter. If this was a brand new entry, it'd be a little bit further out. But this is really crazy, guys. Think of this. If this one only won 10% of the time, it would be a profitable trade. That's how insane this payout is. 1,576% ROI at expiration. It's not going to win 80% of the time. It's not going to win 50% of the time. This thing, even if it won 20% of the time, you're a crazy good trader. So keep that in mind here when you're taking this max ROI spread on this specific trade on NVIDIA. All right, Nate, flipping it back to you.
All right. Well, thank you for that. One of the things, I'm going to get my screen share started. While I'm doing that, Gabe, do we have that? Do we have that little form in there that we can drop?
Yeah.
We were going to try to get some feedback from you guys to figure out who's newer here. Where are you guys at kind of on your overall journey with opening, closing playbook, with Graham and I? Alex asked, what does wrap order mean? So like, that's a great example. Alex might be a little bit newer, hasn't gone through, some of the training, things like that. So Dave's going to pop that link. And if you guys don't mind, I mean, that'll probably take, what do you think, Dave? 72 seconds
or less. 60 seconds or less.
Not even 72 seconds.
Yeah.
Just pop that form up if you don't mind. It doesn't even ask you for your name or email or anything. It's just basically saying like, hey,
5 questions.
What's your experience? How many sessions have you been to? A couple basic things like that, just so we can get an idea of who's here. Obviously for Graham and I, it's really important to tailor these sessions to make them as valuable as we possibly can for you guys. That's why we're here. That's why we're spending the time to do what we're doing. And the more information we can get regarding where you guys are at, the more helpful that would be. So if you don't mind taking those 53 seconds, I've adjusted my expectation too. Click that link. It'll just pop up a quick form and you can do that. All right. With that said, let me jump into a quick overview here and then we will get into our Ask Us Anything session. I'll try to go through this in the next, let's say 25 minutes, give you guys some time for that before we wrap up. So this week we had an extremely rare 2 losses in overnight options, which we were just talking about. So yes, full transparency. We had 2 losses in overnight options this week, which, happens a couple times a year. So obviously quite rare. And so one of the big questions I get, especially if we do take a loss, is why didn't we use the stop loss? Why didn't we manage that trade? Or how could you even trade with the negative risk reward? I took 2 losses and that wipes away 8 wins. How is it even possible to ever be successful with that? And while I understand both questions, and I think they're fair questions, I do think they are built on misconceptions about trading to some degree, kind of talking points or things that people hear that are not necessarily based in the actual logic and math and probabilities when it comes to trading. And so as usual, my answer for both of those questions is the math. I just trust the math on this kind of stuff. That's why I'm very mechanical in my trading from A to Z. I don't really want to have to answer those questions on a discretionary basis and say, oh, I didn't really feel like it today, or I thought the market might bounce back, or really give any other question. I just really want to be able to trust the system. And that's precisely what we do. So the core idea here with something like overnight options, and by the way, several of my other strategies, is that if we give the market the maximum amount of time to hit the target, our win rate goes up to such an extent that it far exceeds the savings by cutting trades off. So most people think, hey, if I cut my losses short, the net profit will be advantageous. Well, actually, in reality, on almost every single way that you trade, although I will give you one example where this is not the case later, which I think is kind of fascinating. But in almost every other case, especially the way that I trade, you actually get a bigger advantage by taking a full loss, letting the market move and give it time to hit your target. And there's a whole bunch of crazy examples I could give you that just I personally think are mind-blowing to prove this out. I'll give you one later, but for now, just understand that's the logic. You give the market the max amount of time, it increases your probability so much so that it exceeds the net profits of cutting off losses. So a few weeks ago, for example, this was a trade we had. So our line in the sand was here. If you guys are new, you might not know what line in the sand means. That basically means the price we need the market to finish at to give us a win. And the market drifted slightly down overnight, it opened right here. So again, we put the trade on the left side of your screen. It opened right in the middle of your screen. And so our position was right around break even at the open. We had not hit our target yet. But then things got ugly. And this is where I really start to get emails, right? When the market starts dropping, I get emails like, Nate, our trade's down. Do I exit? Why don't we have a stop loss on this trade? I'm losing money. Oh, I should have exited earlier. Nate, there's no alert. You didn't tell us what to do. What do we do? And folks, I get it. This is hard. When the market is going down and you're losing money, trust me, I'm losing money too. I don't like it either. I understand. And so no one really likes my answer. If you guys are with me, you probably know, and you may have experienced not liking my answer. But the reality is our default approach here is to do nothing. Do nothing, sit back, let the trade work. Remember, one of the keys to spreads, the way we trade in that line in the sand, is that we're no longer fighting time. And so instead of fighting time, we actually want to use time to our advantage. And this is, in simple terms, what I think most retail traders get very wrong. They spend their whole life fighting time instead of flipping it around and using it to their advantage. So this is what a call option would look like. If you guys had bought a call over here, right, waiting for the market to go up and the market started going down, your call option would be losing value and it would continue to accelerate over time to the negative downside. I'm not sure if everyone in the room today has experienced enough with call options to know what I'm talking about right now. Maybe give me a yes in the chat if you do, and give me a no in the chat if you don't. But this is the acceleration of time decay. This is price going against you, plus you now have time going against you, because with a regular call option, a big part of the value is the time itself. So in this case, it actually does make sense to exit early. If you just had a regular call option, it would make sense to exit, because even if it does bounce later, it likely won't matter, because with a regular call option, it would need to bounce up, but it would need to bounce so much up that it overcomes the price that you went down and the time decay that you're losing. All right. Again, if that's not clear, we can spend a little extra time going through this later. But if this was a regular call option, it would make sense for that reason, because you are saving some time. But our debit spread is more like this. Okay, it doesn't have that same curve. Basically, it's reacting directly to price. So it's going down when the market goes down, but then it's flattening out. We're not going on this curve. We're not saving time here. It's reacting much more closely to price itself because it doesn't have that time decay layered on top. And that's incredibly important, because it means that it can also respond positively with price. Okay, so it can also respond positively with price. And if it bounces up, the value will bounce up. You can also think of it in terms of risk to reward. And this is the part that I think most people really never consider, but I think is very important, which is to think about it in terms of risk to reward. So on this trade, our target was about 20%. If you traded 10 contracts, you would have risked about 700. Your potential was 140. There's that negative risk to reward that people sometimes get a little nervous about, but once you understand the math, I think you get very comfortable with. So the total value of the trade equals $840 at the target level. All right, you risk 740, but if it hits the target, you'll make 140. So the total value of the trade was $840. All right, so just keep that in your mind, that if you hit the target, the total value, the gross value is 840. What you will have made is 140. But, this is a big fat but, when the market dropped, the trade was now down 80%. So how much could we make if we win now? The trade is down 80%. Remember, our target, risk 700 to make 140, but now the trade's down 80%. Most people think you can make $140 on the trade because that's what your target was from the original setup, but that's actually completely wrong. The real-time value of the trade was about $140 of net liquidity. That's what you could get. So if you close the trade right here, you would have actually gotten $140 left on the trade. But remember, the total value of the trade is still $840 at our target level. So what could you actually have made from this point in the trade? no longer 140, right? The new risk reward is actually risking 140 to make 700. Again, a little bit hard maybe to get your mind around at first, but it's just the facts. It's just math. Your trade was only worth 140 here. And so if you hit the target, you will now make $700. And based on all my testing, that is a worthwhile risk reward at this point in the trade. By the way, then the trade actually got worse. This was about 2 weeks ago. I don't know if you guys remember this one for my overnight options members, maybe 3 weeks ago at this point. It was down like 95% at this point in the trade. I mean, the trade was dead. It was dead in the water. So we had about 35. You risk 700, but it's only worth $35 at this point in time. So now the risk reward is leaving the $35 of risk on the table for the potential to make $805. If it hits the target, people think they made 140, but actually from this point, you made 805. And that's really important because it tells you how you evaluate the trade. Again, on this trade, it actually came back and won, which is, pretty remarkable to flip from that losing situation to the winning situation. Now, just to be extra clear, when a trade is down 70 or 80 or 90%, we usually do lose. Okay, I want to be very clear, very honest, very transparent about that. When the market is crashing against you, we usually do lose. It happened yesterday. Okay, we were down big. It looked like it might bounce, but it didn't, and we lost the trade. But the point here is not always to keep it open because we're going to win. That's not the point. It's not saying, hey, listen, don't worry, leave it open. It'll always win. Don't get me wrong. The point is that the few times that you flip the losers into winners make all the difference. Okay? So the obvious question is, are you saying you are willing to lose 100% when you're wrong? For me, yes. And that's one of the best parts about trading. I can use this structure to have defined risk and max the time potential, give it the most time to be positive or hit my target. Think about it like this. Most stocks don't move in a straight line, right? A stop loss is like saying, I want to lose money anywhere in this zone. Joseph, no, it's not happening today because we already hit our target today. So it can't happen today. A profit limit with no stop loss is saying, I want to make money anywhere in this zone, right? So that's the difference. A stop loss is saying, hey, cost me money. A target is saying, hey, give me money. And for the average trader, I can't think of a bigger advantage than simply giving yourself way more ways to win and way less ways to lose. I say this all the time. I think retail traders tend to trade where one scenario gives them a win and every other scenario gives them a loss. I want to flip that and make it where one bad scenario gives us a loss and every other scenario gives us a win. All right, so let me prove it. Before I prove it, James said, sounds like funky math unless you're talking about doubling down. No, James, not doubling down. Just looking at the actual math, the true math on the trade. So the true math is this. If you risk $700 and the trade becomes worth $100 because the market is down, the trade is truly intrinsically only worth $100 at that point. That's what it's worth. If you close it out, you get $100 of net liquidity back to your account, which means you lost $600. But if the trade stays open and hits the target, you have legitimately, not theoretically, legitimately made $740 from that point. Your true real-time risk reward has actually changed because the value of the trade is a living thing. It's not like it's still worth 700. You can go back and get that 700. It is now only worth 100. And yet at the same time, if it hits the target, it will still be worth 840. So both things are true, which means your risk reward is legitimately changing in real time. All right. So that's the math. That's not theoretical. That's not doing anything funky. That's not assuming doubling down. That's just literally the math. It is weird. Don't get me wrong. It's hard to sometimes wrap your mind around, but it's super important to understand you can't go by what the trade started being worth. You have to go based on what it's worth right now. No, Manny, you're misunderstanding what I'm saying. Okay, let me try to get my draw. I don't know if I can draw on. Can I draw on here? Maybe. No, I don't think I can draw. I need to get the whiteboard out because that's the only way I can. Oh, I messed something up on our.
You can
canvas,
draw
by the
in
way.
StreamYard.
Can I? Because I just clicked the pencil and it didn't let me.
Yeah, that's what it should let you do.
It said
maybe-
make a new layout.
Oh,
It's
no,
like-
it's just editing the layout. Sorry, my bad.
okay. I'll get my pen out and just share the screen a different way. This is I think this is important enough to do this. So I'm gonna take a moment because I think this is one of the hardest things for people to understand. It's weird, but it's true.
The reason the recovered part is considered profit, man, it's not profit on the overall trade. It's profit on what you do when you're at the bottom, right? Like when you're at the bottom. So a lot of people think of it as, well, this is how much I put in, this is how much I need to get out, or this is what's happened so far. It doesn't really matter what's happened so far. It matters what happens where you are right then and there. When you get out 20% down versus stay in while you're 20% down, you're making a choice on the number that's 20% down. You're not making a choice on what you originally got in at. If you got in at 100 and it's at 80, you're making a choice. Do I get out at 80, which means you're going to get $80 back, or do I stay in at 80, which means you're risking 80? What you lost, the 20 you lost is not there. The 80,
it's not there. Exactly right. It's not there. It doesn't exist. People want it to exist, but it doesn't exist.
Is not there. You got in at 100. It's worth 80 right now. Your decision right now to stay in or get out is based on it's worth 80. It could go to 120. That's now 50% gain on the 80 that I'm risking by staying in. It doesn't matter what you bought it for.
Yeah. Let me do it like this. So, okay. So at 9 a.m., oh, that's not clear enough. Okay. Let me do it like this. At 9 a.m., you have a 10K account. Okay. At 9:30, you put $1,000 on the line for a trade that could turn into $1,500. Okay. If this trade wins, your account will be worth 10.5. Okay. Everyone agree with that? If you have a $10,000 account and you risk $1,000 to turn into $1,500, it's a net $500 added to your account. And so if you win that trade, your account will then be worth $10,500 because you won the trade. Hopefully everyone agrees so far. Now, if at 10 a.m. the trade is down 50%, this 1K does not exist, folks. This is $500. How do we know that? How do we know it's true and it's not a theory? Well, because if you close the trade, your 10K account would be now $9,500. So if you close this trade, your account is no longer $10,000. Your account is $9.5K. So guys, we're not comparing this to if you didn't take the trade, because you did take the trade. Okay? This assumes you took the trade. Not like, oh, if I went back and just didn't take the trade. No, we're comparing it to the real practice of you are in the trade, because that's what matters. Does everyone agree that if you close the trade down 50%, your account would be $9,500? This is the true liquidity of your account. This is what your account is actually worth. In fact, let me even say it more clear. Even if you didn't close the trade, does everyone agree your account is worth $9,500 at this moment when it's down $500? Okay? So what Dave is saying is, if you are looking at this trade and making decisions based on this 1K or this 10K, you're in an imaginary land. It's not me who's in the imaginary land. It's you who's in the imaginary land at this point.
Whoa. I did not say that.
Dave said you guys are foolish. No, Dave. No, I'm just saying it. If you're starting to think, well, my account's really 10K. No, your account's not 10K. Your account is 9.5K. So here's a simple question. This is where conceptually it feels weird, but it's accurate. If you now decide, I am not going to close this trade, I'm going to keep this trade, and from 10 a.m. to 1 p.m., you hit the target, and this trade now is worth $1,500, And your account then does go to the original 10.5K. Sorry, that's supposed to be 10.5K. So from 1 p.m., it does hit the target and it goes back. Here's the simple question. How much money did you make between 10 a.m. and 1 p.m.? From 9.5 to 10.5. Did you make $500 or did you make $1,000? In real practice, not in theory, not in, what if I didn't take the trade or I didn't choose to exit? In real practice, how much money did you make from 10 a.m. to 1 p.m.? Did you make $500, which was the original quote unquote max profit? Or did you make a very real $1,000? You made a very, very real $1,000. Not a theoretical $1,000. Not a, I guess if you do it that way. No, your option was to take your 9.5 balance and walk away and go home. That's what your actual account was worth. And 3 hours later, your actual account was worth 10.5K. So you made a very, very real $1,000 between 10 a.m. and 1 p.m. I know I'm really hammering this. Maybe I'm being obnoxious. I don't mean to be, but I just think this is so important to understand, because if you start evaluating trades on a theoretical, what your balance used to be or what the trade was worth at the beginning, you're throwing all reality out the window. You're now not even judging it based on what, the true reality of what the price is worth now, and therefore how to make decisions going forward. So like Dave said, guys, you can't take into account what your account used to be worth. You can only look at what it's worth right now in the moment and then make the decision. Okay? So hopefully that makes sense.
Go ahead, Dave. Before you left that screen, I just wanted to say, if we take 2 more minutes and demonstrate this on the flip side. Let's say from 10 to 1, it goes from 500 to 1400, right? Mm-hmm. Your goal was 1500, but it goes from 500 to 1400. This is why sometimes we set targets and we get out before the max profit, because you're, in a way, if at 1 p.m. it's worth 1400, you're making a decision at 1 p.m. Do I stay in at 1400 to get the extra 100, or do I get out at 1400? And what you're doing is now, the closer you get to your profit target, the more you're risking for a smaller return. So when you're at 1400, you're risking 1400 to make 100. If Nathan gave you a trade and said, here's a trade that's going to cost you $1,400, and your max potential ROI is $100, would you take that trade? And most people would not take that trade, which is why many times when we get close to that, we take profits and we leave, because trying to eke out that last little bit is risking that $1,400 to make a very little.
Yeah, absolutely. Now, so for those of you guys saying, okay, yes, but you still made $500 on your risk. You still made a 50% return on your risk. Absolutely, yes. You made a $500 return on total risk. But what we're comparing here is whether you should exit. What we're comparing here is, should you stop out? And so you have to compare it based on what your account is worth at 10 a.m. or in this case, it could be anytime, but we're comparing the actual exit versus staying in. Now, you're still making 50% on your risk, when you look at the trade, but the comparison here is, should you get out? So that's what I'm trying to draw your attention to, because that's the question I get is, why didn't we use a stop? Should we get out? So let me show you a good example of this. So this is just a kind of a typical example of a way that I would trade here. This happens to be May 22 through April 2025. I guess we could bring it up to speed here and give it to what's today, September 26th.
It is.
I have to go before today. Let me run it again real quick. This is like a typical strategy for how I would trade a defensive trade on the SPY below the price. And what's interesting here is that you could trade this a whole bunch of different ways, and it'll typically work pretty well. 90% win rate, 10,000 to 515,000. I don't know about you guys, but I would take that. 90% win rate. So this is like a solid strategy. Notice that the starting capital and ending capital here is 10,000 to 515. Okay, so that's what you would have made here over. Sorry, what is that? 3 years, 3 years and some change. If you put a stop loss on this strategy, it will still work. But notice how impactful trading out some of these wins for losses. So let me just go down here. Right now, the take profit is 17%. That's not a magic number or anything. Don't get caught up on that and say you should always use a 17% take profit. It just happens to be where that middle line often ends on the dollar spread when you're going in the money. We won't go into that now, but I'll tell you about it later. So if you just do a 1-to-1 risk to reward and you do a stop loss of 17% and you run the exact same test, the exact same 600 trades, using the same exact metrics, same entry, same exit, for on the take profit side, all of that, but you just add a stop loss to get out of the trade and keep your risk reward healthy, because a lot of people want to keep their risk reward healthy. Notice the curve is still really nice, really good, and you actually do manage risk really well. But you guys might notice something about that ending capital. It's a lot lower, right? So the curve still looks nice. Outside of realizing how much quote unquote risk you're taking off the table, you don't realize that the capital has actually gone down dramatically. Okay, so your risk goes down dramatically. So Rick said it's more psychology. I would say it's not more psychology though, Rick. That's actually what I would kind of reject in this case for exactly this reason. You would lose $400,000 over this particular test in 3 years by getting out. So I would say it's really not a matter of psychology. It's a matter of practice. Do you get out of the trade or do you stay in the trade? So in very real practice, when you get out of the trade, the 48 times or whatever that you get out of the trade, you are legitimately trading out a loss structure for a potential target. So I guess that would be my argument there is actually it's very much an in practice structure there where you are trading a decision to get out and lower your balance versus a decision to keep the trade open and hit your target. But anyway, we can dive into that at a different time. And if you guys have any further questions, we'll return to that. I did want to show you something I found that I thought was pretty fascinating here, Dave. You'll have to put me on record because this might be the only time people hear me say this. So take it, record it, play it back to me. Yep. I did find a situation where a stop loss seems to be potentially effective. And that is when you're not doing a defensive trade, but you're doing more of an aggressive trade. And the idea here actually does make some logical sense. Now, I was just messing around.
The more out of the money you are.
Right. And if you think about it, it makes sense, right? Because the more out of the money you are, you're kind of starting off with the risk. And if the market goes down, that immediate price is going to be a little less sensitive. And if it moves in your favor at the beginning and you want to hit a target and then it comes back, okay, go ahead and get out because now you need such a big move in your favor to hit that take profit anyway versus just rebounding to break even being a win like it would in overnight options, right? So in overnight options, if the SPY rebounds to a break-even day, you win. But if you're starting with a directional move and it's moving against you, maybe it does make sense to get out because you're saying, hey, it's already moving against me. I not only need it to bounce back to break even, I need to actually have a directional move. So maybe that's the case. But here was the example I gave. No, guys, this is not a strategy that you should trade. This is just an example I found. This is like a wrap order or very close to a wrap order. What you're looking at is saying, okay, I want the market to move like a 0.25% in my favor. I did the same dates here. Let me see if I stretch this out. I forgot to actually open the dates here.
I always hate to equate it to gambling, but I always feel the same way when I play blackjack, right? If I'm questioning whether to take another card, I know if I go over 21, I'm out. It doesn't matter what the dealer has. If I'm over 21, I'm out. I've lost before I started. You got to stay in to win. And maybe there's a chance your number's higher than theirs or they bust. But like, it's always, I know like blackjack's more of just a straight statistical thing, but that's always kind of my feeling. I really, at least the emotional part of that to this, which is you have to stay in it to have a chance of winning it. And as soon as you stop loss out, then, you you're not playing anymore. But if you already have a huge amount to make up when you get in the trade, like if you're going aggressive and you have a climb ahead of you to begin with, and then you drop even further down, I could see why, like, it's too high of a thing to climb at this point. You're never going to win with a 3.
And I think that could be the case. Just, I mean, again, guys, don't take this as gospel. This is me like really throwing something at the fan here that I just kind of looked at, which was just going slightly out of the money. This is 10 to 16 grand over the last 3 years. And what we're doing here is we're using a 30% target on a move that's just, slightly out of the money here. Like you can see, it's just 0%. So basically a tiny move. And what I noticed is if you put a 50% stop loss on this, it seems to make it more healthy. It seems to put you in a position where, like Dave was just saying, like, hey, if you're not going to climb the mountain, you start falling down, go ahead and get out. It seems to be that logic fits better for a more aggressive trading strategy. So you can see here, it went from 10 to 16 to 10 to 46,000. So like I said, Dave, this might be the only time you hear me say these words, but with a stop loss, this strategy looks a lot better. Even though it's an option strategy that I would typically say, don't use a stop loss on. But this is one. So I don't know, guys, if you want me to, I can mess around with this a little bit more. I literally just threw a couple random ones at the wall this morning as I was messing around with this idea. I could try to see if let me put it this way. If a lot of our members, Dave, are people who want to feel protected like they have a stop loss.
Yeah.
I could try to build an opening playbook strategy that has a stop loss. Now, the reason, full transparency, the reason I think that makes no sense is I think you just risk what you want to risk to begin the trade with, right? So if people are like, oh, I need a stop loss because I don't want to risk, well, I would say, well, just do the contracts that you are totally happy to risk. Instead of risking $2,000 with a 50% stop loss, risk $1,000 to begin with. Yeah. So that would always be my defense there. But if people feel, hey, healthier risk reward, I want to feel good about, my risk reward ratio, I can mess around with this. I could kind of create an opening playbook strategy.
I think I think sometimes we try and force other people into our psychology, right? And not everybody fits the same mold. So I think there are people out there who want that. We could easily say, look, this is a defined risk strategy. Put into it what you're willing to risk on it. Here's how the numbers go. You're going to win 8 times, and the 2 out of 10, and the 2 times that you lose, you're going to lose all of it. But you're going to, your winnings are going to eke out ahead of your losses by this percent or by this much. And so just if you put $100 every time, you're going to win a percentage on your 100, 8 times, and then you're going to lose your 100 twice. And this is where you net out ahead. Some people are cool with that. Some people can do the math and they can have the kind of, emotional restraint to not make changes based on those 200% losses. Some people would rather be in a strategy where they know that they're not going to take a full loss every time. And even if that means that they net out maybe a slightly lower net ROI, they rather have the safety net on their trades.
Yeah. I think that's true. That I do want to force everyone into my psychology, Dave.
Yeah, no, not just you, like all of us, everybody, even all of our traders in our network with different trading strategies and psychologies, kind of all want to say, and it's not really forcing people into their psychology. So maybe that's a harsh way of putting that, but that the trade strategy requires a certain psychology. The strategy itself requires a psychology. The strategy,
that
the overnight options requires that if you want, maybe requires isn't even strong, but like if you want the best net ROI out of overnight options, this is the way to play it. But if you want a safety net on your trades where you're not going to lose 100% of your net or your original investment, your debit or whatever, here's a different strategy that you can play that way, or play the overnight strategy that way, but you're going to take a hit on the net ROI. Yeah,
no, I do think that's fair. So guys, we have about 10 minutes left to kind of get into some questions now. We will also we didn't fill up all the spots for the HQ All Access yesterday, so we'll give you guys one more presentation on that. If you want to stick around, I mean, that's the most low pressure offer ever, because that's basically saying for any of you guys who want to go all in with me and get everything I'm doing, including the new stuff that's in the pipeline and the development stuff that I'm really excited about, you can join me with All Access. So we'll play that presentation if you want to hang around for that. If you don't know what All Access is, that's basically what I just said. how do you get everything that I'm working on all in one package, lifetime access, including everything I'm working on in the future, the big ideas I've got in the pipeline now. But again, clearly not for everyone. That's for a handful of people who want to go all in with me, but we'll play that. But first, we've got about 10 minutes to ask questions. So let's hang out and do that for 10 minutes, and then just stick around if you want to learn how to do TT Trading HQ, which of course I would love to have everyone available for. Okay, Dave, do you see any questions here that we should jump on? I saw DPT said how to trade the opposite of call debit spreads. If you're looking for stocks going down, it would be a put debit spread. So you would do the same thing, and you would literally just invert that trade. So put debit spread, or I guess they would call long put spread, would be the same idea, risk defined, and then if it gets below the sold put, it's going to be a max profit, just like if you did a call option and got above the sold call, it would be a max profit. So same exact idea. Most brokers are going to call that a long put vertical.
There were a couple questions around what you were just presenting, and about like dollar averaging, when it does go down, instead of a stop, either like averaging out your stop losses or moving your stop losses, or dollar averaging a second trade. I don't know if you want to address that, but
I don't know if I captured everything just there, but I would say, because I'm reading chats while listening, which is a horrible idea. I would say for me, I actually am fine with cost averaging on assets, on buying and building a position. I'm not a fan on doing it for trades. Okay, so assets and building a position, yes. Trades, no, that's me. And the reason for the trades is because everyone I know who rolls trades or cost averages on trades, they are not doing it because that's the best trade available. That are doing it because they started with that position and they want to stick to it and turn that position into a win. And if you just take one step back for a second and think about it, that makes no sense. If you have a meta trade and it's down, you think, oh, I'm going to roll it because I want to win on meta, but actually you like Google better, you're just throwing money at meta to psychologically feel better that you turn meta into a win, even though the money is still gone. Just like the example, you still lost the initial money. You're still throwing the same money at the trade. It doesn't actually make any sense in most cases. There are a couple scenarios I can think of that are different. If you're thinking about those scenarios, those would be like RSI, expansion trading strategies, stacked support levels, things like that. Sure, those are a little bit more complex, but you can make sense of them in those cases. But in most cases, I would say just one look at it, think, yeah, that actually doesn't make any sense.
A couple questions that I can answer. One is, no, there is not a live Apex Master class today, but there is one recorded in the members area. If you haven't watched that, definitely go ahead and watch it. There was some talk about Apex being today because because Graham did those trades using the Apex software and demonstrating that this morning, that we did some live trades out of Apex, but there's no master class today. There is one recorded in the members area. And also for a couple people that are having trouble like reading the details on Nate's screen, I'm posting an image in the chat here. If you go to the bottom right corner of the presentation, you might see a little button that says auto. If you click that and switch that to 1080p, you should see it clear up in a couple of seconds. The only thing is, you may, if you have a slow internet connection, you may wind up getting like a choppy. Well, it doesn't help if you enlarge it, Nate. Then they can't tell if the 1080p worked. But I mean, it helps. But if by setting it to 1080p, you'll get the best resolution. But if you start getting a choppy presentation, a choppy like video stream, then you'll want to lower it back down.
Rick said, "Yeah, I agree with you. It would only be real accounting if you close the initial trade." Rick, that part I agree with you. It's only real accounting if you close the trade. But that's what I was trying to compare to. I was trying to compare the literal difference to using the stop loss versus not using the stop loss. So I agree with you, but I guess that's my point, is that in the other situation, you would be taking your account from 10K to 9.5, because if you use the stop loss, you would be out of the trade.
Yeah, I think like the simplest net takeaway from that whole thing, in my opinion, is It doesn't matter what's happened before right now. You're making a decision based on what it's worth right now and what you think it's going to go to. And that's the decision you're making every moment that you look at it and say, should I get out or should I stay in? You're risking what it's currently worth versus what you currently think it's going to go to.
Yeah. Yep. Yeah. Chris M said martingale strategy can be costly for sure, especially, depending on how you do it. If you're doing it with leverage, if you're doing it with open-ended positions, there are modified martingale strategies that I think can be very effective, especially with options and debit spreads, because you have defined risk on your ladder versus something like a 4x martingale strategy where the open leverage positions stack on top of each other, a whole different animal. But yeah, I agree. Someone asked about a masterclass for Apex. Yes, there's absolutely a recorded masterclass. I can answer that for Graham. I can't answer all the questions for Graham, but that one I can answer. There's definitely a masterclass in his Apex.
Chris asked, you need to be in overnight options every day for the numbers to make sense.
I mean, close. I guess a little bit of a nuanced answer there.
Yeah.
You can't pick and choose your spots. I mean, you couldn't get lucky and make it more profitable, but obviously that could go the other way as well. In general, a strategy that trades every day is going to have a small profit factor, right? Overnight options is not going to have a big profit factor. It's never going to have a 2.5 profit factor. It's going to have a small 2% per day net average or something. So you do have to stack it up in order to take advantage of it.
I think that's not to say you can't miss a day, right? Like
Correct.
It's not to say you can't miss a day. The point is that if it's a 4-day-a-week strategy and, we base the stats on, hundreds and hundreds of trades, and you're only taking one out of every, 15 to 20 trades, who knows which ones you're landing on? Your numbers are not likely to average out exactly the same, but the profitability of the program doesn't change. Just where you're hitting it being so random, if you take it just once in a blue moon, but still on any given trade, right, you've got an 80 whatever percent chance of winning. So even if you took one overnight option trade, it has that odds, but you're not going to see, if that one trade you made was a loser, then you're going to look at it and say, well, it's got 100% losing rate because I took one trade and it lost. So if you want the numbers to resemble, the reported stats, then you need to be in a lot of trades. It doesn't necessarily have to be every single one, but you need a good statistical data set.
Mitch asks, explain overnight options at the end of the day before closing and let it expire the next day or watch it. Well, it's actually neither, Mitch. We put it at the end of the day every day, and then we put the target on the trade so that any time over the next 24 hours, if it hits that target, we're out. That was kind of that first test I showed you. I mean, that wasn't the exact overnight option strategy, but fairly close, actually, where we're just letting those targets hit and stack up with as high of a win rate as possible.
Manny, none of this has to do with Newton.
Chad said PTD. Yeah, PTD is stupid, but I think they're getting rid of it. It looks like that will
like Q1,
be going away.
Q2, we're hoping.
Yep.
Q1, Q2, we're hoping to get rid of that.
But you can do different accounts. I know a lot of people do that. They do, they have a Robinhood account and they have a Schwab account. They do 3 in one account, 2 in the other account. So maybe they have $8,000. They put 4 in each and manage it that way.
All right. So there's a lot of confusion over programs here. So we've done a lot of talk about overnight options, but what Graham did originally when he was giving out the trades this morning came out of the Apex software. When Nathan started talking about like the strategy of exiting with stop losses, a lot of that was centered around overnight options because we had a loss yesterday on overnight options, and a lot of people were asking about whether they should have gotten out early. So we have 2 different things that we've talked about so far. None of it has to do with Newton. None of it has to do with income machine, really. And honestly, what Nathan was talking about with stop losses isn't really specific to overnight options.
No, it's not.
It's just an overall. It's just an overall like strategy or mentality around it. So like I'm not sure where all the questions are coming about. Like, but you want to tell them what you're looking at on the screen right now because I think they're trying to figure out how to look at. Some people are trying to figure out how to look at that.
Yeah. Well, let me start by saying just more fundamentally, every day at 10 a.m. We do opening playbook, which is not any program, guys. This is our free session. So for those of you who are in here and you're not sure what you're in, This is our free daily session. We do 2 of them every single day, 10 a.m. and 3:30. Just Graham and I's way of trying to give some free training out there. We have lots of services, strategies that we sell that we'd love for you to join. And we make no bones about that we think they're worth money and that you should buy them. But we also try to give as much free education as we can because we know everyone's at a different place in their journey. I think Dave and I were talking yesterday, and he said he thinks half the people probably shouldn't buy anything for a while. They should paper trade. They should try different ideas. They should get comfortable. Of course, I rebuked him and said, "What are you talking about? They should buy all my things right away." But that's what this session is for. Let's not start out by saying, Graham and I, hey, we have really cool ideas, and if you want to know anything, swipe your credit card. We want to start out by saying, hey, we're here. We're trading in the market every day. We want to show you things. We want to teach you valuable lessons. Whether you ever buy a service from us or not, we hope that we're a blessing to you and we can give you value. But of course, on the flip side of that, we'd love for you to join a service. As a matter of fact, in about 2 minutes, I'm going to play the most elite service you'll ever see, which is my all access, where you could literally, most of you who are brand new, of course, it's not going to be a fit for you. But if you want to join everything I do, which is, a dozen strategies and lots of tools that I'm working on, and I highly recommend it, and I'm not shy about saying that I highly recommend it. But that's not what this is. This 10 a.m. is the free session. We usually play one of our presentations on the back end of that, and 3:30 is the same thing. So just fundamentally clarifying, that is what we've got going on here. The screen you're looking at right now happens to just be a test I was sharing in the example when I was walking through when you might want to use a stop loss, when you might not want to use a stop loss. And I like to do it with the data. For me, it's easiest to see things and understand things with proven data, because that makes concepts actually feel like reality. And so that's what I was showing here. But I would turn it off because that is kind of confusing now that we've been talking about other questions for 15 minutes and I still have that screen up. Guys, I will give you 1 more minute if I missed any questions, or Dave, if you think I missed any questions, and then we can play that Tucci Trading HQ.
There was a lot of talk about, there was a lot of kind of people answering other people. So there's a lot of stuff here to go through, just about kind of the trading strategy and the stop loss thing. So that is a little hard to kind of make our way through. Let's see.
Keith asked about the SPY. Brandon W answered that. Thank you, Brandon. Yes, it is. Overnight options is connected to the SPY. So we are looking for a small overnight drift in the S&P.
Yeah. So for trades that are several weeks out, so there's a question about if trades are several weeks out, but it's pretty low, you're going to wait. Your general theory is wait, give it a chance to come back. Particularly with that much time.
Yeah. And maybe just to say it as universally as I can, if you are trading good stocks that go up more than they go down, then giving it time to go up will typically be to your advantage. You can't do that with regular call options because you're fighting time. But with the way we trade, you can do that. And that's where I think the big advantage comes from. It does start with the assumption that you're trading good assets that you actually think should go up more often than they go down. Because if you don't have that advantage, well, then time is just a coin flip. It doesn't help you at all, right? You give it 2 weeks, you're still just 50-50. But if you're trading Apple, trading NVIDIA, trading Meta, if you're trading S&P, QQQ, then you actually have a very big advantage baked in. They go up more often than they go down. And so we're trying to use that advantage.